I'm going to ask Dr. Cheryl, could you read the first paragraph for me? I appreciate it.
I'll try them on my phone.
No problem.
Variable universal life insurance combines variables and universal life insurance. Essentially, flexible variable life insurance, a VUL, allows the same types of investments options as a variable life insurance policy. Your cash value growth depends on the investment performances and builds tax-free so long as it stays in the policy.
Thank you very much. A VUL also allows you to alter the insurance coverage with ease. I'll say that again. A VUL also allows you to alter. It means augment, change, flip, higher, lower, the insurance coverage with ease. You can decide the amount and frequency of premium payments within specific limits. Now, you can't go crazy with it. Saying, all I want to do is send y'all $1 a month. No, that's not going to work. But you can decide, once again, you can decide the amount and frequency of premium payments within specifics. So they give you a range. They give you a range. Now, if you stay within that range, you're working within the range. You must pay at least enough each year to cover the underlying insurance cost, which goes up each year. With a VUL, you build cash value while young, so you can use it to cover more expensive premiums as you get older. So that's why usually if you're in your 50s and 60s, this would be the wrong time to get a VUL. Like my children, my oldest child is 30, going to be 31. She and her siblings, this would be a perfect time for them to get these type of insurances. But they would have to be diligent, consistent, and recognize this is not something that, I'm only doing for 5 years and forget. No. This is where your adult mind has to kick in and be like, yo, I understand it. This is part of my insurance strategy. This is part of my wealth building strategy. Look, I got to work this thing so it doesn't work me. So now, flexible premiums, adjust payments based on your budget. You can do that within the parameters. As you heard, you can decide the amount and frequency of premium payments within certain limits. They're going to give you, okay, this is low you can go. And if you decide you want to go higher, that means you're kicking it up a notch. Okay. You big baller shot caller. Build cash value. It grows assets while young, so that when you get older, it covers your future costs. Usually people who get this, the VULs, are probably people are more aligned to say they're going to end up in a retirement community. And instead of just taking all their other insurance products and saying, this is going to cover these expenses, no, they'll probably use this type. So say they're going to move into that, adult condo community, or willing to, put down something, whereas, they no longer want to take care of a home and they move in one of those communities where, certain things are provided for them. This is the type of insurance policy you would get. But usually, I would say something like this you would get probably in your 40s, the latest. If that's the case, get your regular whole. My advice, and this is just my advice, what I'm saying. This is what Greg would do. Not telling you what you should do. I'm telling you what Greg would do. If I was still in my 40s, I would get something like this. Because you needed to have time to know exactly what am I using this particular policy for. It may not necessarily be for a death benefit. You're probably using this. You say, I'm going to end up in that retirement community. Okay. When it's time for me to pull out and I've hit retirement age, okay, let me pull out this cash value to go take care of that. I went through the thresholds. I paid the premiums. Da 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 da. I'm ready to, and this thing did well for me. Boom! This is now covering my retirement home. An option. Not saying you have to do that. It's just an option because everyone's particular life is a little bit different. As we move on, variable universal life insurance key advantages. Maximum flexibility. That is a wonderful advantage. For those of you who may feel that you're in certain cost structures, that your cost structure may be going up and down, there's maximum flexibility. There is. Variable universal life policies offer unparalleled control over your insurance coverage and investment strategy. That means you have to be aware of what that particular policy is investing in. If you just put it in their devices, you have no one to blame but yourself if it does not grow in value. Because believe you me, they're going to say, we're in partnership here. What is it that you desire for us to put the money that you're giving us per month? Because this is a variable universal life policy. And if you sit there and stick your head in the sand, that's a bad move. So again, here are some of the key advantages again. Flexible premiums. Change how much you pay each year based on your budget. Must pay at least enough to cover insurance costs, which will increase over time. Adjustment death benefits. Increase or decrease your policy death benefit. Add more coverage for protection or decrease to reduce your costs. It's very simple. So if you increase your policy death benefit, you know you're going to be circulating more dollars towards them in your premiums monthly. You say you're having a bad year and all of a sudden, you know what, this year I got to, kind of cut back a little bit. Okay. And your death benefit is going to be lower that particular year. And as long as you stay within the parameters based upon what you have established for that next 12 months, it is what it is for those next 12 months. Investment variety. Invest cash value between various investment funds. Cash value investments grow tax-free as long as the money stays in the policy. Just like the variable life insurance. As long as you ain't touching it, the cash value is growing, you got a beautiful thing. You have an insurance policy with an investment part to it. And growth potential. Strong investments boost cash value and death benefit more quickly than regular universal life or whole life policies. That's why certain people in key management roles or certain corporate types, they have these type of insurances. Why? Because if they have it aligned with their company that they're working for, and say you're working for one of these technological companies that just blew through the roof, they say, okay, yeah, just invest everything in that, and that stock went 1,000%. All of a sudden, they have it invested in that, or say strategically, so just stay in this vein, even though you really wouldn't advise that, but certain people may make that choice to do so. I believe in this country so much, in this company so much, and all of a sudden they look at their insurance statement and they're smiling. They know, after a while they may, adjust, but during that time frame, during that growth spurt, their cash value and their death benefit grew very nicely. But see, that's when you're moving in, I'll say, beginning to be rich, wealthy, and affluent, which we all here have the potential to be. Those who are here live and even those on the sound of my voice for the recording, you have the potential to go there. VUL insurance the important drawbacks. Higher expenses. Just recognize that everything in life costs something. There are higher expenses. Additional administration and investment fees beyond standard policies. Remember, there is an investment part to this VUL, just like in the variable. These are people who are watching these markets because technically they don't look good if they're always losing money. So, of course, with anything, if you have someone who's attempting to get you 10 or 15 or 20% per year in the money that they're making for you, of course they're going to charge a percentage. They're going to charge a fee. No one works for free. As much as we would like to, there are no slaves here. There's no one that works for free. So surrender charges typically apply for 10 to 15 years. So usually with these type of accounts, after that 15th year, now you've passed that threshold. You've seen that cash value grown. You've spent at least the past 15 years making those premium payments diligently, and you've seen that you should be sitting very well. They did what they were supposed to do, which usually you have a part to play in that as well. Market volatility risk, just like in the regular variable. Poor investment performance can reduce cash value and death benefits significantly. It's like a brokerage account. Oh my God, that stock I was in went up to like $80. And then you turn around 5 months later. Oh my God, they're talking about this company's bankrupt. Okay, did you jump out of there sometime? Kind of saw the dive happening. Did you jump out? Or you just went down with the Titanic? So you always have to be very mindful. You see those, especially if you have these type of insurances or annuities and things like that, those letters come in the mail, open them up. Know what's going on. Look and see, oh, did this grow over the quarter? Because I know I have a certain annuity that I get the statements every quarterly. How did the market do? How did it affect this annuity? So I'm aware. And I know at least once a year I get those packets where the packets are a little thicker. It says, okay, we have different, funds that we're inquiring about. We're informing you. So would you like us to move your money over here? And and you start making those choices. Rising costs over time. Without sufficient cash value built while young, you may face much higher premiums later in life or lose coverage. That's why I said, usually a VUL or a variable, you're already say in your 50s, I would, from what I know and what Dr. Clark would do, I would advise you not to get one of these. Now, Dr. Clark wouldn't get one of these. Because I understand now, would I advise you to still get some whole life insurance? Of course, even though you're going to pay a higher premium based upon your age. But do you have that disposable income, or you feel like you like to have another type of insurance to augment what you already have? Of course. Now, if someone came to me at 25 years old and said, oh, they're trying to get me in this VU, I say, jump on it. You young enough. Oh my God, but it's going to take like $300-$400 a month. Look, you banking money. If you're younger, you're banking money. Oh, they talking about investments and stuff like that. And then all of a sudden you go visit that same individual 15 years later. So, yo, you still got that account? You still got that policy? Yeah. How much is it costing you? Same $300 a month? But yo, that cash value. Just that and the third. And plus I got in it when I was young enough and and I was diligent and I was responsible. Exactly. That's why this conversation is not just because we're becoming the elders or the griots in our respective community. This is a conversation for those who are younger. Because wealth can start to generate while we're young. But I don't see any old people anyway. We're all as young as we deem ourselves to be. And if we make the right choices and right decisions, then we can benefit as we make the respective choices. And no guaranteed death benefit. Cash value and premium payments must cover insurance costs. Steep market losses could eliminate your ability to afford coverage. That's why usually brokerage houses, those major banks, are the ones that usually are the main ones that will offer these type of products. Because they recognize they're dealing with high net worth people that technically they're not desiring for them to lose their money. So this is just something else that they put as a part of their repertoire. It's not the end all be all. This is not the only thing that they would have. They would have this, they would have that, they would have other policies, annuities. My sister talking about TDAs, maybe a Roth IRA, maybe something else like, all types of different things that their money is working in. So you're getting grabbing dividends from here, growth potential there. Let the money work for you, just you not working for it. Which policy is right for you? We have variable universal life, which is flexible premiums and control. Variable life, stability with guarantees. And your choosing goal is simplicity or flexibility. You're going for flexibility, you're going to variable universal life. You're looking for stability, which will move towards a simplicity because even though it's not simplistic, but it's more simplicity than variable universal life, then you'll go variable life. I mean, that universal word removed from the middle, and you'll just be at variable life. And the key questions to consider as we start to bring this to a close. Do you want regular premium payments? It's variable life. Do you want to guarantee a minimum death benefit? Variable life. Do you desire, because I don't really like the word, do you desire to alter your death benefit and premiums? Now you're moving towards universal. Variable universal. Are you comfortable paying more later in life in exchange for flexibility? Then variable universal life would be your choice. Important note, both policies require taking on investment risk in your life insurance. Depending on market conditions, your beneficiaries may receive more or they may receive less than expected. Because remember, it's invested in the markets. And the final statement, the key comes down to whether you want simplicity with more guarantees or flexibility with more risk. And with that being said, we are complete with the teaching tonight. Oh, Miss McIntyre is in the building. Make sure I acknowledge her. All those Floridians down there and Mr. Guthrie getting some of our cold air that we sending down south. They get to act like they back up north. Amen. Any questions, thoughts, statements as we bring this edition to a close? Bring this train back into the station. Any thoughts? Let me go to Dr. Sharp. Karen got a mic open. Go on, Karen.
It's a lot of information here.
Mm-hmm.
It's a lot of information, a lot to learn.
Mm-hmm.
So, but I want to know. So,
That's good.
yeah.
That's the excellent part of it. And that's the thing that's so wonderful about it is that when you put yourself in the space, we're going to come to you, Mr. Jackson, but when you put yourself in the space of becoming now more financially literate, see, we all need that. We all need that. There's nothing to sit there and say, oh, I know everything. And this, no, 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 no. It's always good to be exposed and willing to be in a space that you're continually learning. Because then, even if something may not necessarily work for you, all of a sudden, as you start to gain and gather the information, now it can be paid forward. And we can share it with those who are younger in our respective families, communities, things of that nature, and recognize, like, yo, we can push you or at least point you in the right direction so you can do a little better. So thank you for that thought. Mr. Jackson, my Nebraskan brother, what's going on?
Yes, sir. Can you hear me good?
Yes, we
You hear
can.
me? Okay, awesome. Yeah, I thought this was great. Now I missed the first with the terms and all that, but I do work in life insurance
Okay.
for a company that I do the like a lot of the tech and process type stuff for.
Mhm.
But the only life insurance I have is through my job currently.
Okay.
And I really hadn't thought about it because, I'm not married. I don't have kids yet. Not to say I could, who knows what'll happen next year. I may meet somebody, pop out a few. But, I was thinking about I was thinking
Yeah.
about life insurance. It's probably, and I'm healthy, they can probably look and say, okay, he doesn't have any issues. I'm not on any medications. I'm not, morbidly obese. So I don't feel like, I would have a bad medical report or anything like that where I would get substandard ratings or things like that. So I was thinking about the cost, but if I didn't decide to go with either, like a whole life or a term, I could see me maybe going with a term with my age or something like that. Maybe whole life, but could it be made up if I decided to do whole life on children and kind of dump into those children policies to kind of build cash value? I know it would help them, maybe not necessarily me, but at least it would be a vehicle that maybe could store something for them later, later on.
Well, that's why if probably all of us probably remember, and especially maybe me being a New Yorker, I remember the Sunday paper, and always in the coupons, there was always that little baby with the Gerber Life.
Yeah.
The Gerber Life baby, and the little white baby, they sit there. It only costs you cents per day. It's like you can get that whole life insurance for your child, and it grows in cash value, this, that, and third, and it only costs you cents per day. And that little baby be smiling at you each and every week, and they be advertising. Why? Because it's the same way that we had the conversation tonight, and definitely if you desire to find out about the previous conversation, it's uploaded on the YouTube channel at Dr. Gregory Clark, Master Coach, the last one where we broke it up when we started talking about whole in life. So it's up on YouTube to catch it if you need to catch a replay along with this. But the reason why that's so important, because as we started to recognize, and I remember doing the research, you'd be surprised how most affluent households, after they get their trust done and stuff like that, it's like, why are they circulating all these dollars per month on these insurances? Because most times, the ones that are wealthy, by the time their kids are like 12, 11 years old, they already got like probably put like $1 million whole life plan or a variable life on them.
Yep.
So
Yeah.
by the time that child is 30 years old and they're saying, okay, you're going to be responsible for this, or we've invested in that. And, depending on how they set up the trust and all that other stuff, it's like, look, you have something that we've been paying into the past 18 years. Now, we got it as a benefit, and we may have the trust as the beneficiary here because we don't know what you've been doing. You could be the prodigal son or something. Or you can be one of those individuals who's part of the family. It's like, wait a minute, this one did everything that we asked. Okay, now you have access to this. You know what you want to do with it. You want to continue to roll in the market with it. Now you're taking over the premiums. Now you have something that is already building cash value, and God forbid if something happens to you, you already got an asset.
Yeah.
So one of the things that I'm recognizing is that for Black and Brown communities, the insurance conversation was always felt like a death knell. Like, oh my God, you're trying to kill me off. Whereas
Yeah.
in other communities will recognize the reason why they start saying, oh, I got some on, Junior. He's 15. Well, he got. No, I'm getting it now. There's a reason for it. And we sitting there like, you want Junior? No, no. We're building. We got him in the right stuff, and we're gonna keep making this investment in them, especially if we own some businesses or we have a nice little business that we're growing. Okay, yeah, we're not looking just to have money so we can circulate and look good. It's like, okay, this is an investment. And yeah, we're investing over here. And we got a policy on grandma. We got a policy over here. And, and all of a sudden it's like, wait a minute, this is the cost of doing business. And if it grows into a space where it goes from, say, a small and medium-sized business into something that's worthwhile and moving into maybe a national corporation or a multinational corporation, you'd be surprised how these insurance products help. And so that's why we're going to continue in the realm of these conversations, because even next week we're going to talk about some other insurance policies. Why? Because
That's
it's just not one size fits all. There's so many products out there that we're either not aware of or not privy to.
Yeah.
And I always go back, if Dr. Cheryl Clark wanted to share the story, because I always think about her story when she was one day coaching some women, and she shared her cautionary tale, which in so many ways is a blessing, because even though she learned better and she got better, but it was a cautionary tale. So, Dr. Shaw, would you be able to share your insurance story real quick in regards to, what occurred to you and how that made you more adept and more learnable about insurances, especially when, certain things were happening to you as you were growing in your career and things of that nature?
Yes. So what Dr. Clark is talking about is that early on we went to one of these, talks on life insurance, and they were very glad to have people that, had the money to get the insurance. So this particular one was a term policy, and I was excited about getting this term policy. I got like, it was like 500,000, right, Clark? Yeah, 30,
Yeah, something like
350. It was like half a million. And because I was so young, I was paying like $171 a month. For me back then, it was great, because it was like, okay, great. So what they said was I could borrow against it. So I was like, I think it was like 10 years I was doing it, right, Clark? It was because I was in my
that.
40s. So
I
I
thought you
wanted
were
to
like 30s, the 30s.
when I got it, I was in my 30s, but when I wanted to draw
Oh,
from
yeah,
it,
yeah.
it was like 40. So I was like, okay, Clark, I think we want to go buy another house, but I can go and do something. I could pull money out of my investment. I think I wanted to do something. I don't know what it was. I think it was another house that we wanted to do. And I went to go get the money, and they were like, oh, well, this is a term policy, and you're not able to draw anything from it. And I remember calling the person that sold it to me, and I was so annoyed. But like Dr. Clark was sharing, the naivete of it all, that doesn't make no, never mind. You need to be very astute when you get into things, because you can't say, I don't know. But I can say, I don't know. But if you do $171 for 10 years,
Mm.
that's a lot of money. I canceled the policy, and I got a whole life. I got like three whole lives. So I just did a whole, I did a whole turnaround.
Mm-hmm.
I got mad at myself, and then I said, well, what can I do? And like Dr. Clark alludes to, every time I could tell the story, I tell the story. But there's a different type of ones that I would say your children, like all of my children are in their 20s, and they all have some sort of whole life.
Mm-hmm.
And there's also ones that I found out, like with my daughter, they even found out that, it's a term policy. You do your own homework. I'm not saying to go ahead and do this. There's a term that turns into
I
a
hope.
whole life
Mm-hmm.
insurance. But it's just for you to do your own, you do your own um
Research.
digging, digging and research. Thank you, Dr. Clark, because it's important for you to do this. Now, Dr. Clark is just giving information to get you educated surrounding the different types. And like Karen said, and hi Karen, is different, is different. It's a lot of information. Take a little bit at a time. He posts the video up later. Take a little bit at a time and do your own research. I would also suggest using Chat GPT. Use these other tools out here to support you in learning. There is no reason why our community is behind. You're behind because you want to be behind. Just start with one policy, get some information. And just because you're 55 doesn't mean that you can't have anything.
Exactly.
So just get the information, and that's it.
Thank you for that, Dr. Cheryl. So, you know, regardless of wherever you're at, as sometimes, not sometimes, as it says in the good book, a wise man, and they sometimes we're not going to be misogynist, because they always used to assume that it's just only a man. So when you look at that word wise man, that also means woman. A wise man or woman will leave an inheritance for their children's children. Not just only a man. A woman can leave an inheritance for their children's children. We recognize the synergy. We can't propagate life by ourselves. So when you recognize that, that's why I knew it became on my heart to make sure that we have these relevant conversations that put us in the space of being adept, not a know-it-all, not, acting like somebody smart. No, that doesn't go anywhere. It's very small and minute. But when you start to recognize that you can move in these respective spaces and be like, look, I'm becoming much more active in what my money is doing. It doesn't show that you love money or you putting love or money above God. You can never put money above God. You can't. That'd be a level of ignorance that's crazy. That's why it says the love of money is the root of all evil. Did not say that you cannot get as much as that you desire to make. And sometimes we can put that and keep ourselves in that 6-7 range that these young kids talk about. Either or. Oh, I can't be affluent. That means no. There's plenty of affluent families that are very faithful, and they show themselves to even be more fruitful because they still hold on to their faith, but they're well off. And we don't have to say some of those family names and stuff like that. You can do your research and see. So we as a community can be faithful and fruitful. You can have both. But you recognize that God still is sovereign and the Most High is still sovereign above all. And when you recognize that, then all respective benefits and things that you desire to do shall manifest for you. So as we start to bring this to a close for this week, give you an opportunity to support the platform here at the Comeback Collective Circle. Please visit CoachClarkDmen.com if you have not taken your fourth quarter assessment and get on the email list. Yes, eventually we will start the newsletters. Some of this information we'll start sharing only for people that are on the newsletters. We're not going to give it out to everyone. Certain things that we may be in certain conversations that maybe we go a little bit further in depth. Maybe I may share some of the things I invest in, choices that I make. I'm not telling you what to do, but I'll tell you what's working for me. And then you make the respective choice. So we're not sitting here as financial brokers or we're your financial advisor. No, we're here to generate a conversation so that you become adept and become worthwhile and being recognized in how wide this world is. This world is not limited to just the spaces that we occupy. This is a large world. And there's a lot of potential for resources to be made if we choose to open our eyes and not close them. So to support the Comeback Collective Circle, you can do Cash App, $ Gregory Clark D. Or if you so choose, you can do Venmo. Just drop the $, same handle, Gregory Clark Demon. Or if you choose to do it via Zelle or PayPal, which we just use to continue the promotion and background work to help keep this platform flowing and growing, we appreciate your support. If it's Zelle or PayPal, same email address, esquire971@gmail.com. So until next week, when we'll be back here at the same great time, same great space, continue to share this information. If you are a subscriber to the YouTube channel, you can even share the YouTube channel with people and say, yo, this is what we talked about this week. Especially Dynasty Path has started since the first Tuesday of June. So everything since the beginning of the year is going to be Dynasty Path the whole entire year. We're going to be adept. We may go over certain things. We may rehash certain things, but repetition is part of learning. In our community, we are behind, but we're going to catch up. We will catch up. So once again, this is Dr. Gregory Clark Sr. saying thank you to all the members of the Comeback Collective Circle that are here with us. And those of you who are watching on the video, take something that you heard from about this variable or universal and apply it. Do your research. If you're young enough, start doing your research to see what is out there that you can afford so you can start your own wealth path today and grow your own dynasty path. So until next week, stay blessed, stay highly favored, and allow for that money to come back to you pregnant. Yes, we do. We want money to come back pregnant. Till next week, y'all be blessed and see y'all next week.
Good night.
Good night.
Good night, everyone.
Good night.
Good night, good night, good night.
Right.
Good night. Good night, good night, good night. Good night.